have three topics to be covered here in this chapter. First, why the specialness, the why are the financial institutions so special? So that will be our first topic. And then we are going to learn why certain financial institutions are heavily regulated. And finally, we are going to briefly talk about the types of the financial institutions, which will be covered later in our lecture. First, let me begin with the definition of the financial institutions. So, a financial institution is an intermediary between the suppliers of the funds and the users of the funds. Here, we have two economic entities. First, we have a supplier of the funds, and this is a person, the corporation, or the government, which have a lot of money. On the other hand, there are also the users of the funds who are in short of the money. However, if they get certain funds, then they have something to use it very effectively. So this is a transaction between the suppliers of the funds and the users of the funds, and the financial institutions are in the middle between these two groups of people, corporations, and governments. So why financial institutions are so special? So if you want to know whether something is important or not, then you can imagine what happens if there is no certain thing. So we are going to think about the word without the financial institutions. So in that case, because by definition financial institutions are intermediaries, so we are going to have the users of the funds and the suppliers of the fund directly connected. So here the households are individuals who saves their money, so they would be the suppliers in the case because they have excessive cash. But on the other hand, we have corporations which need money. If they have the cash, they can invest the cash into valuable projects like doing research and developments, or inventing new patents, or recruiting new employees, and so on. So they need the money, so therefore they can be called as the users of the funds. And then it is possible that these two groups connect to each other directly without the interference of the financial institutions. And then maybe we can have some equity and debt claims. That is a contract. So this is often called as the securities. So in the financial markets, we can see some securities like stock or the bond. So they are nothing but the contract. And this contract is between the investors and the corporations, the borrowing companies. So here, investors are the households because they have the money, and the corporations are the ones who borrow the money from the investors. And by issuing stock and the bonds, the corporations make a promise to the investors that in the future they are going to pay certain money back the investors, and right now they receive cash in return. So this is a potential contract without the financial institutions. And it seems that this kind of world actually works not that bad, but there would be certain problems in this case. So I'm going to talk about what are the drawbacks or the pitfalls when these contracts are only possible. First, there could be screening cost, monitoring cost, and liquidating cost. So let me talk about the disadvantages when we do not have the financial institutions in terms of the financial cost. To understand the cost related to the non-existence of the financial institutions, you need to understand the situation called information asymmetry. So the information asymmetry is a situation where different people have a different level of information. So for example, one or a group of people know much better than the others, and then there could be certain problems, because if you know better than the other, then you can utilize it. You can fool the others because they don't know whether what you say is true or not. And therefore, from the beginning, if you go back and think about from the perspective of those without the information, they would not trust the counterpart. So they would not try to engage in certain situation. So let's think about the adverse selection, which is a typical information asymmetry situation. So to understand this, I can give you an example about the market for lemons. So there is a research article named "The Market for Lemons," written by George Akerlof, who is a American economist. So if you happen to visit the United States, the problem of the United States, contrary to the Europe or the Asia, is that the land is so vast. So, however, the public transportation system is not that good. So therefore, you need to drive yourself whenever you go to a grocery shop. So even if you are a university student, you need to buy a car. However, you cannot afford a fancy new car, right? So therefore, many of the Americans just go to the used car market and purchase ones. And there's the problem. So the problem with the used car market is that you are a newcomer because you are not an expertise in the car industry. So you can be fooled by the seller. So what happens is that you are not going to believe what they are saying. For example, if the seller says that this car is worth of for example, $100,000, then you will say, okay, I guess so. Then maybe I can just go around and I will just look around and see what are the alternatives. So this kind of market is very, very difficult. It is not easy for the buyers because you cannot trust about the qualities of the cars sold in that market. So that's why the George Akerlof called it as the market for lemons. The lemons are looking so good, looking so delicious if you just look at the yellow color. However, if you taste it, you will you will just spit it out, right? So you cannot know what's inside of that product. So that's the problem of the used cars. So this is a typical market failure, and the reason, the original reason why it happens is because there is an information asymmetry. So you do not know much about that. So if we come back, to the situation here, the problems are that corporations will argue always that their corporations have bright future, and if you invest, and you will be a $1,000,000. However, and they will also argue that you should not miss that opportunity to invest in our company. However, it is true that still maybe some of the corporations are just some kind of fraud. They are not worthy what they are saying. So as an investor, here the problem is that you cannot trust the corporations, of the quality of the corporations. And another problem is that, right, so that's the typical problem with the information asymmetry, especially about the adverse selection. So therefore, in order to avoid that kind of difficulty, what you need to do is to screen out. So you need to investigate. For example, in the used car market, what people usually do is that they seek authorized sellers, not just anyone, but authorized by the government or by the state government, or maybe some authorized by the manufacturers, so that you can have at least certain level of the trust about the counterparty. So that's the screening cost. So maybe you need to spend more because you need to investigate whether the quality is good or not. And the second problem is the moral hazard. So this is also another aspect of the information asymmetry. The moral hazard means that the counterparty with the information will be kind to you only when they try to make a contract. Then after the contract is made, then they will just turn their face off, and they are just going to be very mean. So that's the kind of the moral hazard. So you cannot bind what they are going to do afterwards. So that's the situation of the moral hazard. So for example, if you invest in a company by buying the shares, it means you are going to be the shareholders or the stockholders, and the manager, the CEO, the chief executive officer, has a kind of duty to you, because he is working on the behalf of the stockholders. So he should do his best to enrich you, so to make the company the best, so that the stockholders can enjoy the benefits from purchasing the shares. However, in reality, many of the investors may have the moral hazard problem. That is, they were already invested in, and they already hold the CEO position, so they do not do their best, and they may spend the cash of the money in something in very wrong way. For example, they just decorate their offices, and whenever they have a business trip, they upgrade their seats, and they will stay in a 5-star hotels, even if it is not necessary. So that's the waste of valuable resources, and the result is that investors, the shareholders, will be harmed. So that's the typical moral hazard problem. And then, in order to avoid the moral hazard problem, you need to monitor. You need to frequently visit the company, and you need to ask questions. Are you doing good? Is it everything okay? Did you spend something bad? And what happened to the last year's revenues? You need to ask questions. That's the another kind of cost you need to spend in terms of the time and the efforts. So therefore, there's another kind of cost when there is an information asymmetry. So finally, the last problem related to the non-existence of the financial institutions is the liquidation cost. So you may heard about the liquidity. So liquidity is the degree in which you can transform your asset into cash. So if you are an investor, so if you have the securities, then this is your asset or this is your investment. But eventually, you need to convert it into cash so that you can buy some good food or the drinks, right? So that's why you are investing from the beginning. And if you can wait, there's no problem. However, in reality, the problem is that sometimes you may experience some adverse events that prevent you from keeping your investment. For example, you may find yourself very ill. For example, you had a medical check and you realize that you have a cancer. Then you need to spend some money to be treated in the hospital, right? Or you may want to go to a higher education institution. So maybe you need some money, or maybe you can have, if you are married, then maybe you can have your own child, and you need to spend some money for them. So and it goes on. So in reality, in every cases, you may find that I need the money right now, not in 1 year later or 2 years later. So even if you decided to invest for 3 years, maybe just after 1 year, you may need to convert your securities into cash. So that's the problem. And then the problem is you had a strict contract. So you need to follow what you have written in the contract. And in this contract, you promised to wait for the 3 years. However, in the opposite side, you have the corporations, and they don't want to bring you the money right now because they already spend the money in somewhere else. For example, constructing new facilities or research and developments. So they cannot give you the money right now. However, you need the money urgently. So that's the problem. So there is a conflict about the timing. And then if you experience that situation once, then maybe in the future you are just going to say, I didn't like the situation that I had to wait, so I'm not going to invest. So you are not participating in the financial market. And then there is a limited supply of the funds, so the users, the corporations, are also worse off. So the market cannot go on. So because that in reality we are human beings and we need to consume every day and we need sometimes a lot of money, we cannot fulfill our promise in the direct contract between ourselves and the borrowing corporations. So in that case, for example, if you have the securities, the alternative that because you cannot get the money back from the corporation, the alternative is that you can sell the securities in the market and some other investors will purchase your securities. In return, they will give you the cash. The problem is maybe the price of the securities can be different from what you expect, and the difference is called as the liquidation cost. So maybe you believe that my securities, my bond is worth $1,000 and you need to sell it today. However, there are only potential buyers who believe that the bonds are worth only $900. And then you are crying. However, there's no way out, so there's no alternative, so you just sell it by receiving $900. And by doing so, you lose $100. So that's the liquidation cost. You need to sell it very quickly, so you just forget about the price and you find yourself experiencing a loss. So these are the problems when you have no intermediaries, when you have direct contracts with the users of the funds. So financial institutions, you can expect what I'm going to say. So the financial institutions can alleviate these three concerns, and by doing so, they help both the users and the suppliers of the funds. So their roles can be summarized as the three terms. First, information producers. Second, delegated monitors. And the third, asset transformers or the liquidity providers. So let me talk about the information production. The financial institutions can produce valuable information for the suppliers of the funds. For example, banks and other financial institutions conduct credit analysis. So they evaluate, investigate the quality of the borrowing companies and check whether they have the ability to pay the money back. And analysts in the securities firm also do financial analysis, and they provide us with the analyst reports about the expected price about the stock. And by doing so, they minimize the screening cost because they have the required background information and the knowledge from their prior experiences. Second, they have professional skills to analyze complicated financial markets contrary to the ordinary individuals. And third, they have the economies of scale. So here the economies of scale means something like this. Let's say there is a stock and there are 100 shareholders and there are no financial institutions. And then shareholder A need to spend certain screening cost. Shareholder B also need to spend certain screening cost. Shareholder C also need to spend the same amount of money to screen and monitor, and it goes on. However, if we have a financial institution and if there is an analyst who covers the stock, then instead of everyone doing the same thing meaninglessly, he will just do it for us. And therefore, this is 100 times more efficient, right? We do not have to do duplicated research for the company. So that's the economies of scale in by having the financial institutions. And second, they can be the delegated monitors. So the delegation means we are giving our authority to themselves, and on the behalf of the investors, they are the financial institutions who monitor the borrowing companies. So, for example, if I purchase the bonds, then maybe I will be very nervous because especially when the borrowing company is in poor quality, because I need to check every day whether the company has the ability to give me the promised interest and to return the promised face value. However, because instead of purchasing the bonds, if I have a bank and the bank gives the loans to the corporation, then instead of me, the bank will check the repayment schedule. So this is the typical delegated monitoring. And second, if you are a shareholder of a company, because having a share means you also have the ownership in the company, so you need to monitor the company's managers. However, usually you don't have to, because we have directors, the board of the directors who work for us. So therefore, the board of directors will monitor the CEOs and other executives. So therefore, you don't have to care about what's going on in the company actually. So the financial institutions can also minimize the monitoring cost, because again, they can reduce the duplicated monitoring cost, and they have professional skills, so therefore they can help us by minimizing the monitoring cost. And lastly, we have the roles of the liquidity provision or the asset transformation. So there is a slight different nuance in the asset transformation and the liquidity provision. So let me explain about the asset transformation first. So the asset transformation means that the financial institutions have the ability to convert certain assets into another asset. Especially whenever they do, they change the maturity, the time of the investment. So the most significant example is the role of the bank. So we are going to learn soon, but the banks receive deposits from the depositors, and they using the money, they lend the money to the corporations in the name of the loans. So here the asset transformation of the bank means they are going to transform the deposits into loans and vice versa. And here the most important thing is that deposits is short term. As a depositor, as a customer of a bank, you can give certain money today, but the bank would also respond to your request tomorrow if you intend to get the money back. So the deposits are short term. You can just put the money just only for 1 day, 1 hour, or even 1 second. There is no penalty. Of course, you are not going to get a lot of interest if you invest for a relatively short term. However, one of the bank's advantage is that you can choose the timing of the withdrawal from the bank. On the other hand, using the money, because there are a lot of depositors and there are a lot of money inside the bank, they can give the money to the corporations, and the loans are typically long term. For example, a typical loans to the corporations are 3 years or 5 years. So the banks do not ask their borrowing companies to return the money very quickly. They can just wait for long period of time, for example 3 years or 5 years. So here bank was able to transform a short-term asset into long-term assets. So by doing so, moreover, they can serve 2 different groups of the customers. So they serve depositors, generally ordinary people, and everyone is happy when you have a bank account. And at the same time, bank can lend the money to the corporations, and the corporations are also happy. And if you had a direct contact with the depositors and the borrowing companies, it may not be feasible because corporations require long-term investment, but you are worrying about the situation of the liquidity issues, so you prefer to have a short-term investment. So your preferences are different. However, banks can fulfill both of the parties' requirement. So that's the advantage of the financial institutions. And a slightly different but similar term is the liquidity provision, and this is about this is not a more in the clarification. This is more about the conversion or the liquidation. For example, nowadays we have a lot of mutual funds. So the mutual funds are the institutions where we can invest our money, and the fund managers will make a pool of our money and invest in certain securities. And we are going to talk about it later, but another advantage of the mutual funds is that every day you can decide to put additional money, and at the same time you can just draw down the already invested money out of the funds. So you also have a freedom of the timing. So you can choose whether you want to invest more or whether you want to exit your investment. So therefore, as I said, so the financial institutions can minimize the liquidating cost. So therefore, they also help the users and the suppliers of the funds. So this figure explains that now in reality we have the financial institutions as the intermediary between the investors and the corporations. So they provide different contract to both of the parties, and at the same time they serve as the monitor and the screener, so they can help the financial markets to be stronger, and both of the parties, the users and the suppliers, can earn certain profits. There are other roles of the financial institutions, such as the channel of the monetary policy. So the monetary policy is a policy determined by the central bank usually. So in Korea we have the Bank of Korea, and in Europe you have the European Bank, and they try to control our macroeconomy by controlling the volume of the money in the economy. So they control the interest rate, and they control whether they want to put more, they want to issue new euros or Korean won into the market. So these are the monetary policies, and in this process, whenever the central bank decide about their monetary policy, the actual delivery or the process happens in the banks. So in that sense, banks are the channel of the monetary policy. If we do not have banks, then the central bank cannot conduct their monetary policy, and they cannot control the economy. And they create the credit. So the credit is, another name of the credit is trustworthiness. So credit is made when someone lend the money to the borrowing entity, and banks and other financial institutions make credit because they are lending institutions. And another reason why we often use financial institutions is because we want to transfer our wealth to our children or the grandchildren. For example, if maybe your parents are going to make you, when you were a child, your parents made you a bank account, and they are going to save some money in your bank account. So this is how family can pass their wealth over the generations. And payments. This is also another aspect that is often emphasized, especially in nowadays because of the fintech. But so payments are possible. So when you buy some food in the convenience store, or when you go to a cafe and if you want to drink an Americano, then you need to pay for it. And this occurs through your transaction recorded in your credit card, your check accounts, and maybe your cash. And those are also related to the financial institutions. And denomination. Okay. So far we talked about a lot of the importance and the special needs of the financial institutions. And let me talk about the second topic, the regulation. And when the financial institutions conduct their special unique roles, they minimize the cost for us. And then, is it free of charge? No. The financial institutions need to take some risk through their process. So the minimized costs are possible because in their process, the financial institutions take a variety of risk: credit risk, interest rate risk, and the liquidity risk. So each corresponds to the transaction cost that I talked about. So the credit risk is related to the screening. The credit risk is related to the delegated monitor, and liquidity risk is related to the asset transformation or the liquidity provision. And I guess that you already know about this, but the basic principle in finance is that there is always a trade-off between risk and return. So there another quote about the trade-off between risk and return is that there is no free lunch. So if you want to eat something, if you want to take something, you need to pay for it. And in finance, if you want to earn the money, then you need to take certain risk. And because financial institutions are taking these risks, they can make profit. So that means whenever the financial institutions take more risk, they would become more and more profitable. So if they take more credit risk, the credit risk means the possibility that the borrowing corporation would not return the money as promised. And if the bank take more credit risk, that means the bank is lending to a corporation with poor quality, and then the banks become profitable. The reason is because by lending the money to the corporations with poor quality, they can charge higher interest rate to the corporation. So that's the risk-return trade-off. So the loan spread increases, and therefore the bank becomes more profitable. However, and then the problem is that financial institutions are also profit maximizing entities, so they seek profit, and easy way is that they take more and more risk. And if they were just typical ordinary industrial companies, there's no problem. They are taking risk, and that's their choice. So even if they fail because of the high risk, then that will be their businesses, not ourselves. If they were industrial companies like some semiconductor companies or computer manufacturing companies or the food industries, the restaurants, they take more risk and they get the return. That's okay. The problem is their roles are so special in our economy, so that if any of the financial institutions fail, that will impact the ordinary citizens' lives. So that actually happened already many times, especially during the global financial crisis of 2008. The problem was that the banks and other financial institutions in America were so greedy. So they were trying to be more and more profitable at the time by taking a lot of risk. Especially, they invested huge money into the housing market by lending money to the house buyers. And there was a housing market bubble, and the bubble crashed. So the banks lost their money and they went bankruptcy. But that's not the end. If banks go bankruptcy, then depositors also fail. And here the depositors are ordinary citizens, just us, investors. So banks' survival is not a simple problem. It matters everyone else. So therefore, governments are trying to impose strict rules regarding the financial institutions management, so that they cannot take excessive risk. They have to be prudent and they have to be safe, because contrary to other industries, their failures would harm all of the citizens. So after suffering from the global financial crisis around the world, a lot of governments made stringent rules regarding the financial institutions. The first set of the regulation is safety and soundness. This is about they cannot put every dollar into single assets. They need to diversify, so that if one sector fails, then the rest of the sectors are still there, so their losses will be minimized. And another is about capital adequacy. So this is about having enough equity. So basically, financial institutions are corporations, but they work not just with their own money, but they get the money from their customers, like depositors. So for that reason, usually the financial institutions' leverage ratio is extremely high. In a typical bank, only 10% of the money is equity, and that means 90% of the money comes from the investors, the depositors. So, contrary to industrial companies, the leverage ratio is very high, and that creates a distortion in their incentive. Even if the bank fails, they just lose 10%, right? 90% suffers, depositors suffer. So they feel like even if we fail, it's just not our problem. So that's another reason why banks and other financial institutions become more greedy. So in order to prevent that, nowadays the banks should have a sufficient level of equity. They need to have their own money for a certain level. And guarantee funds. We are going to talk about the guarantee funds later. especially when you deposit your money in your bank account, a very, very small portion of the money will be transferred from the bank to the deposit guarantee funds, so that even if the bank fails, you can have the opportunity to get the money from the guarantee funds. So this is related to the deposit insurance, so I'm going to talk about it later. And we have financial supervisory authorities. For example, we have in Korea, we have Financial Supervisory Service, FSS, and this is a monitoring agency who supervise the actions and what they do in the financial market. And another set of the rules is about the consumer protection, and this is typically related to the information provided to the customers. So here the term incomplete contract means when the financial consumers purchase certain securities or very complicated financial asset, they do not get the full information required. Maybe the sellers, the financial institutions, may hide certain information. So in your financial contracts, the letters are very, very small, right? So you cannot see. So everything is the contract is so long, but you do not have enough opportunity to read it, right? So that's the typical incomplete contract. And this is strictly forbidden, because as a financial institution, you need to provide sufficient information so that the customers can make rational choices. Entry barriers. So this is something that contradicts your usual common sense. So in other industries, it is better that there are a lot of sellers so that they compete each other. For example, if you just go around, there are a lot of convenience stores. For example, international students in Korea, there's a lot of convenience stores. So GS and right, everywhere there's a convenience store, so you can get what you need 24 hours a day. But because there is a competition, you can enjoy it. However, for the financial institutions, for the financial market, too much competition is not that good, because if financial institutions compete each other, they need to survive, so they are going to take more risk. So they are going to take more risk again and again, and eventually everyone will fail. So therefore, the governments usually limit the entry into the banking sector or the securities sector, and by providing certain rooms for the existing financial institutions, by guaranteeing their survival, they say, hey, you can survive, so don't take too much risk. So that's the entry barriers. So in the market, there is a limited authority, limited charters for the banks. Okay. And then let me move on to the types of the financial institutions. So this is my classification. So I often classify financial institutions into three groups. First, lending institutions. Second, contractual institutions. And the third, investment institutions. Here, the lending institutions mean these financial institutions lend the money to the corporations or other entities. There are banks and mutual savings bank, credit unions, and finance companies. Especially the banks and savings banks and credit unions are called as depository institutions because they collect the required funds in the form of deposits. So they take deposits and they provide loans. On the contrary, finance companies are non-depository institutions because they do not take deposits. They borrow from other corporations, and the typical example of the finance companies is a credit card company. So the credit card itself is a lending because whenever you make a transaction using your credit card, you promise to give the money to the credit card company in a month, right? So you are borrowing for 1 month. So credit card is a payment transaction. At the same time, this is a borrowing or the lending transaction. So the finance companies are also lending institutions. And the second, contractual institutions are providing us with specific contracts that help us for the lifetime. There are insurance companies and the pension funds who will provide us the money for our everyday lives after we retire. And finally, investment institutions are certain companies work in the stock market. So we have securities companies, security firms, or investment banks and venture capital and the mutual funds. Please note that we have banks here and we have banks here. In Europe, especially, these are not different. Usually in the European banks are usually commercial banks and at the same time they are investment banks. However, in Asia and in America, the commercial banks and investment banks are different. Commercial banks are those who take deposits and give loans to the corporations. On the other hand, investment banks are a larger security firms. For example, the Goldman Sachs, Merrill Lynch, they are the investment banks. So they are different in the rest of the world. Okay. And if I need to point out the number one priority in different types of among the different types of financial institutions, that I'm going to pick the bank because banks are the basic financial institutions and they take huge portion in our economy. So deposit institutions, so they include the banks, and this is the statistics from the United States. And in 1860, deposit institutions, in terms of the assets managed, deposit institutions, the banks take 90%. Of course, thanks to the development of the financial market, now we have a well-grown stock market. So the importance of the banks are decreasing. However, still, at least 30% of the financial assets are held by the banks. And in your everyday life, you cannot live without the bank, right? You need to use your credit cards, which are often linked to your bank account. So nowadays, this is not possible to imagine a world without the bank. And therefore, I would say that the banks are the most important financial institutions. So that's why the series of our lecture begins with the banks, and we move on to the other types of the financial institutions. And another thing that I want to note is that there is a change in the second rank and the third rank. So before, in the past, the secondly important companies were insurance companies. But if you look at the statistic in 2018, there's a 31.5%, and it's the investment companies. So the investment companies are the mutual funds. So they provide you a way to invest in the stock market indirectly. And thanks to the development of the financial markets, everyone wants to invest in, for example, Nvidia, Apple, Microsoft, or TSMC. Then you can rely on the funds provided by the investment companies. So they are actually, it is the most higher ratio, right? So investment companies became so much popular nowadays. Okay, so the rest we are going to recover. We are going to cover the rest of them again when we talk about the specific type of the financial institutions. But today, let me briefly talk about the depository institutions, including the bank. So the depository institution is a financial institution which collects deposits and it makes loans. Again, the typical example is the bank. So it takes deposits and it makes loans. And in the category of the depository institutions, we have the banks. But throughout the semester, when I talk about the banks, I would try to call them as the commercial banks, because I want to distinguish between the commercial banks from the investment banks, right? And there are also savings bank, which is a smaller but similar entities to the banks. And we also have credit unions or credit cooperatives. We are going to cover in chapter 3, 2 or 3. So you need to note that, especially for the depository institutions, they need to consider two different types of customers together. They have depositors and they have companies. They receive the money from the depositors, and using the money, they lend the money to the borrowing companies. So banks are complicated because they need to think about the two groups of customers together.